Ever wondered how the seemingly abstract concept of inflation can shake the very concrete world of finance? Let's explore this fascinating topic. Inflation data, specifically from the United States, has been making headlines recently. The Consumer Price Index, or CPI, which measures the average change over time in the prices paid by urban consumers for a basket of consumer goods and services, rose by 3.1% this January. This increase surpassed the expected 2.9% and has had significant implications on the market's expectations. The ripple effect of this data is quite intriguing. The higher-than-expected inflation figure has prompted a shift in market expectations for a Federal Reserve interest rate cut to mid-year. A month ago, markets were pricing in a high likelihood of an interest rate cut in March. Now, that scenario seems less likely. The FedWatch tool from CME, a company that runs a global markets company, shows that the probability of interest rates remaining unchanged at the Fed's May meeting is now at 60%. So, what does this mean for the economy? Well, higher inflation generally leads to higher interest rates. This is because policymakers at the Federal Reserve increase interest rates to slow down the economy and curb inflation. Higher interest rates, in turn, make borrowing more expensive, which can slow investment and output. Recent comments from Federal Reserve officials have also added to the inflation narrative. Two officials have indicated their support for increasing interest rates to combat inflation, which has added to the market's anticipation of additional rate hikes. Now, it's important to remember that inflation data isn't just a number. It's a reflection of economic trends and forces. It can influence the decisions of policymakers, businesses, and investors. It can impact everything from the value of your savings to the cost of your groceries. In summary, the recent rise in the Consumer Price Index has surpassed expectations, prompting a shift in market expectations for a Federal Reserve interest rate cut. The probability of unchanged interest rates at the Fed's May meeting is currently at 60%, indicating a significant change from a month ago. The discourse around inflation continues to evolve, with Federal Reserve officials indicating their support for rate hikes to combat inflation. So, next time you hear about inflation data, remember that behind those numbers are real-world effects and implications, shaping economies and influencing decisions.